Hi, I'm Lisa Leiter. In Chicago Business Today, local real estate investment trends. A new report reveals that Chicago has improved in the eyes of real estate investors over the past year. The Emerging Trends in Real Estate report, released by the Urban Land Institute and PricewaterhouseCoopers, shows that Chicago has a 5.14 rating on a 9-point scale, with 1 being abysmal and 9 being excellent. 5 is considered fair. That's an improvement over last year's ranking, 4.65, which was the first time the local market had dropped below fair since 1994. Even with the slight increase in the rating, Chicago as a market for commercial and multifamily investment still ranks 9th among the 15 largest metropolitan areas. That's primarily because every major market saw its score increase since the last survey. For the second straight year, Washington, D.C. topped the list, followed by New York, San Francisco, and Seattle. Earlier, I sat down with Bruce Miller, head of Jones Lang LaSalle Capital Markets Group in the Midwest, to talk more about the report and the local real estate investment outlook. So, Bruce, why does Chicago, in your opinion, continue to rank so low in this survey among other major metro areas? The report says that slowing region-wide demographic trends are diminishing our chances for a robust recovery. Would you agree with that?
Well, this happens in every cycle. So every time we come out of a recession, what happens is that investors will focus in particular on the coastal markets. The interesting thing is if you take a look at the fundamentals that are going on in some of these markets in the Midwest, our market hasn't fallen anywhere near as much as some of the coastal markets did. Our vacancy rates have dropped nowhere near as much as, say, Midtown Manhattan, for example. And there is, in fact, a disconnect between what's going on with some of those fundamentals and investors' appetite for investing into those markets.
What's the major difference coming out of this downturn versus past downturns that you've had experience with?
Really, the construction cranes really got turned off as we hit the downturn, mostly because the financing spigot was turned off. And as a result, we didn't see new properties come online. And in fact, it looks like it'll probably take us a little bit longer coming out of this recession for us to see some of that new supply come online. And that bodes really well, I think, for those people who are owners of property in terms of trying to hold and maintain their value in over the next couple of years.
We had that recent unprecedented deal for 300 North LaSalle. We've got the Hyatt Center on the market now. But still, less than a quarter of the respondents in this survey said that Chicago office properties are a buy. What do you make of that?
One of the big knocks on Chicago historically has been, in fact, that we have a tendency to build a lot of new buildings. And by doing so, that depresses rental rates, so the argument goes. The truth of the matter is, if you take a look at over the last 10 years or so, those new buildings that have come online have fared extremely well. They've all leased up very well, and in fact, they've sold at numbers that have made those developers a lot of money.
Okay. The office properties in the suburbs, though, are another story, and the report didn't mince any words about the outlook there. What's your take? Do you think things are going to get much worse before they get better?
The suburbs, because it has a higher vacancy rate, has seen more distress than, say, the CBD has here in Chicago. And so we've seen a little bit more activity from that front. Because the suburban submarkets tend to be a little bit smaller, it only takes a couple of large tenants to start taking up pretty big blocks of vacancy and bringing those vacancy statistics down as well.
All right, Bruce Miller, thanks so much for joining us.
My pleasure.
As for other recommendations in the Emerging Trends report, apartment properties were once again the most popular asset class among investors, with more than half of those surveyed recommending buying them. And despite concerns about local manufacturing, 46% of those surveyed showed interest in snapping up industrial properties. That's up from just about 30% last year. Well, that's this edition of Chicago Business Today. For more on this story, be sure to check out ChicagoRealEstateDaily.com. Thanks for watching. We'll see you tomorrow.